What is going on, investors? Hopefully you guys are having a great Monday out there. Time to talk about Simon Property Group, ticker symbol SPG. Over the last year, this thing's up just 119% year to date. Look, this thing's up 46%. And I hate to pat myself on the back, but we've been recommending this stock all along the way. Back in June of last year, when this stock was sitting at about $60 per share, we recommended buying it. Back in August of last year, what did we do? Right when this stock is at around $60 per share, we recommended buying it again. And then back in November, when this thing was still about $60 per share, we recommended it buying again and put the icing on the cake. Back in February, this thing had rose a little bit up to $95 per share, but I published a video saying there's 30% upside left in this one. And guess what happened since then? We realized that 30%. We went from $95 up to this $120 mark on SPG. So we'll talk about it. Is the run over? Is it over from a technical perspective? Because as you can see, this was our March drop that a lot of stocks made. And look, all the tech stock, or most of the tech stocks, rebounded within a month or two. It took this one, about a year, a little more than a year, to recover all these losses. But here you are, all the way back from a technical perspective. So we'll talk about that. Now, not only have you achieved 46% growth and 119% growth over the last year, you've also been getting a nice juicy dividend, currently sitting at about 4% yield, although this one's higher if you obviously bought it back when we recommended the stock as well. Now, what's exciting is Simon Property just reported their earnings, and if you know that this is a REIT, this is a real estate investment trust, they basically operate, if you're not sure about Simon Property, the majority of their properties are like quote-unquote A malls. So A malls are different than your regular mall that has like Old Navy's and like just your run-of-the-mill Macy's and things like that. A malls typically have stores like Rolex and Burberry and Louis Vuitton and those higher end, Nordstrom's, things like that. And that's what typically Simon Property operates. And those malls, while there's certainly, all malls have certainly seen traffic's decline, the A malls have survived a little bit better than kind of your run-of-the-mill, maybe suburban type mall. Now, the FFO, which is funds from operations, which we'll talk about here in a second, it's essentially net income for a REIT. We'll talk about how you arrive at it. Well, that's coming in from $970 to $980 per share. So for the full year, Simon Property is guiding for earning $970 to $980. Consensus before this was at $966. So they're bumping that up. And what I want to talk about is the dividend rate is $5.20 per share. And this company is looking to do $970 to $980. So not only is that dividend locked, my opinion, it's probably going to go up. So if you've been holding this for a while, you're probably doing pretty good. Now, we'll jump into the numbers. We've got our 3 months ended here. Right-hand column is last year. Left-hand column is this year. We've got our revenue here coming in the top line. Look, things are pretty flat, okay? But all things being considered, that is good. People are anticipating we come into the summertime and then that all-important fourth quarter where, look, maybe you have all the restrictions kind of taken off the malls and capacity type things, and things can get even better. Not only do you have shopping at these types of malls, you have dining and restaurants and those types of things. The more and more we can get back to that, companies like Simon Property will continue to thrive. So all things being considered, revenue basically flat. So you'd be like, wow, you know what? Everybody's been focusing on these tech stocks and EV stocks and all these energy stocks, solar energy stocks. This company has had flat revenues, but over the last year, the stock's up 119%. So value is not always in the form of top line growth. Now, they've done a nice job keeping expenses. So here's our total expenses here. They went from $698 down to $635. That gives us our operating income here basically flat. Okay, it's down about $50 million, but it's down a little bit. It's almost 10%. But all things being considered, very, very nice. Now, they make some adjustments here. You've got your interest expense, some other stuff going on, and they come down to consolidated net income actually up about 5 million over the previous period. Went from 505 up to 510. Now, as you know, when we're analyzing regular companies, yeah, we're paying more attention to this operating income and certainly net income to a certain degree. For these companies, these REITs, we will scroll down. I'll show you the balance sheet just really quickly. So they've got these investment properties here about the same. So this is at the beginning of the year in December. Left-hand column is the most recent quarter that they just finished. All things being considered, everything looking fine there. All things being considered, total assets almost dead flat. Now, from a liability perspective, ticked down just slightly. Looks like we paid off some of the mortgages and things like that. And if you're worried, look, this is $26 billion worth of debt. This is how any real estate investment works, okay? They borrow money from the bank, they go buy properties, they depreciate them over many, many years and collect rent over many, many years to make back their money. It's how a mom and pop landlord works. It's how much larger one works. So that is the nature of this business. So they have these rather large interest expense. When we come up here, they spent $200 million in the quarter on interest, but that's just the nature of the business, okay? That's how you grow these things big, is you borrow money, you essentially leverage your assets to buy even more of them. That's just the nature of the business. Now I'm going to float down here to our FFO per share. So here's how we get from net income to FFO. The reason why you want to do that, you might ask yourself, well, why can't I just look at net income? And you certainly could if you wanted to, but funds from operations on this, and that's what FFO stands for, fund from operations for the REIT. It gives you an idea how much money they're making from the renting, having a mall, renting it to a Nordstrom or a Louis Vuitton or a Rolex or a Peloton store or whoever wants to rent. This gives you a really clean idea. So we pull down this net income number. Like I talked about, it was 5 million over the previous year. Went from 505 up to 510. We get to add back things, okay? Stuff like depreciation and things like that. Depreciation, they have to recognize that from an accounting perspective, but it's not a cash charge. It's not cash coming out of the balance sheet or coming out of the bank account of Simon Property or you, the shareholder. So they get to add back those type of things. Now they have these gains on sales. They subtract this. So while the gain on selling a mall or selling a piece of property or whatever it is, or selling a segment of the business, that does impact the company from a cash perspective. It's not a clean way to analyze operations. So we subtract that out. We add some things back in, subtract some things. That gets us an FFO from an operating partnership of 933. So while the net income went up, it went from 505 to 510. This FFO from the operating partnerships gives you a better sense of what happened in the business. It actually went down from 980 to 933. But number one thing to understand is shareholders don't give a crap because this thing is rocketed up nicely. But we can also understand what has been happening in the environment with them. They're still having trouble maybe collecting all their rent, and they certainly have stores from a capacity perspective, and certainly new stores aren't opening. Anybody that wants to open up a new retail store, or almost everybody, is kind of taking a wait and see approach, waiting for things to get back to normal. You get things back to normal, new stores will come in, those types of things. Now, we get down to this diluted FFO per share that came in at $2.48 per share. We were at $2.78 in the previous period. Okay, so our FFO is down a little bit year over year, but so is our revenue, so is our FFO from operating partnerships. So all things being considered, relatively flat, okay, to down, but it's this guidance that I think people are excited about. Now, the shares are trading off a little bit in after hours, but it's basically just wiping off a gain that we had during the regular section. Now, from a technical perspective, this thing has come full circle. Okay, we made this drop. I drew this line. This line is, honestly, this $130 line has been on this graph for the entire time we've been analyzing this stock for the last year or so. And we've been analyzing this thing as it worked its way up. Now here we are sitting all the way back to where this stock really broke down right in February and March. This thing broke down, and now we're all the way back. Do we have this 50%, 30% upside left in this stock? I think the air is out of it a little bit, okay? But what you're looking for now is a close and a break above 130, okay? Or in that range, 129, 128, about where the stock is right now. We're looking for a close above that for this thing to continue to move on and back up. I don't know exactly if these are all-time highs, but these were the highs we made before the hell situation, back up to 155. That is still $30 more than where the shares are. But here's what I would look at here. Okay, this 130 level should be I would anticipate a pretty hard level of resistance, okay? Right in this 130, even 120 looks like it was resistance for a while and we broke above it. It wouldn't shock me if this stock comes back to 120. That could be your first spot to buy this one. There's also an area down here at 110, okay? This is if you want to accumulate this one. This is if you want to start a dividend portfolio or keep adding to it. This is a stock that continues to pay this dividend of $5.20 per share. They will announce later this month an update to this quarterly dividend. And I'm going to tell you right now, because they're guiding to 970 to 980, and they actually boosted it from the consensus of $9.66, wouldn't surprise me at all if this dividend rate kind of ticks up a little bit. Now, from a price from FFO perspective, look, we're sitting at 12.94. I mean, this thing is trading at like 13 times price to FFO. Everything is looking very strong. And this FFO is actually not updated. They have the old 966 consensus, and now they're guiding to, like I said, 970 to 980. This thing's probably trading even a little bit cheaper than that. So I like to accumulate this. Now I think you're accumulating it more for that 4 or 5% yield that you're probably going to get on this one. Probably a little bit less in terms of price appreciation. Okay, down here at the $60 level, it was a no-brainer buy, and I certainly did buy it at that level. And back up here at 95, probably not slightly less of a no-brainer than at 65, but certainly a good buy. Now that we've reached kind of a technical resistance point, not necessarily buying this for that capital appreciation, which can come. You break above 130 like we talked about, then that brings in these all-time highs, 145 to 150, back in play. You don't get above 130. Personally, I would actually be excited because that means this one will probably get rejected into the 120, 110 range, and that could be an area where you buy this stock. So hopefully you guys enjoyed this one. Hopefully you got on this train. Look, we've been covering this stock for a while now, almost a year. Leave me a comment down below if you are able to get in this one as well. Hopefully you guys are having a great day out there. We'll be back with more videos again very soon. Good luck with your investments.